And he's saying 5% or better return on investment. I think from that standpoint, that is a little bit of a reach in this environment. Now, when you go to, say, the S&P 500 from 1999 to 2000, 2018, I think the S&P in this particular Vanguard account I'm referencing, and I generally is the one I refer to, and it's a mutual fund, they return about 7.05% over that 20-year period. Bonds, their total return bond fund in that same period returned about 4.65. And if you were using index-linked investing and had a 50% participation rate, you averaged about 5.6. And that actually, that index-linked strategy would have outperformed equities. And yes, it had a lower return because equities lost money a number of years. Equities do that. So when you kind of say I want a 5% or better return, and they're kind of, and I'm not sure because of the arrow on there, was that 5% less or better ROI?
I think that's supposed to be 5% or greater than. They use the greater than less than symbol.
Yeah.
So something bigger than 5%.
I always think of, here's how I think about what's a reasonable expectation on return. We always want more. I want more money. I want more growth. How can I get more? But what's a reasonable expectation? Don't go out there because you can't say, well, I want a 7, like I gave you that 7.05% average. That was an average. It doesn't mean the money gained that much every year. You go to years 2, 3, and 4 of that 20 years of 1999 to 2018, there was negative returns there. You lost money in that account. And then there was years you made money, and then there's years you lost money. And you're going to be unhappy at times, but it shows that average, but that's a misleading average. So then if you want to look, what's a reasonable expectation if I look at money growing going forward? So you don't know where to predict the negatives are when you're using something that can go down in value. And we know a 7.05 was not a positive number every year. It just simply was the average of the positive and negatives over that period of time. So when I look at that, I always kind of look at what's a reasonable expectation, maybe 4.5%. Our bond strategy that we use in ETFs that we get guidance from BlackRock on, I think its dividend right now is around 4.5%, but bonds can move up and down as well. So once again, I go to what's a reasonable expectation there, and we've got some historical basis to kind of say that's a reasonable expectation. But once again, if you're using 10-year treasuries, that's not a good number to use as well. So it's relative to what you're trying to do. But if you're going with equities, I think that's a better number than trying to say, 6 or 7, or somebody said, well, over the past 90 years, and I don't know this is a certainty, but this is what people tell me. The market's averaged 10% over the past 90 years. I don't know that that's true, but the market's not gone up every year for the past 90 years. The market goes down. Then it goes up, then it goes down. That's what we're having it do every week for the past week. Every day for the past several weeks, it seems like there's an up day, there's a down day. So when we go something, what can be a reasonable expectation of going forward? And then you probably are blending, and you should. And if you do have equities, you have bonds, and you have some index linked or assets that aren't exposed to risk, what are you looking at them as a whole? Do you have them blended properly, meaning probably mathematically? And then you're probably picking out one of them and saying, what, I hadn't made any money there. Why isn't this working? And everything doesn't work all the time. So I'm not giving you an answer on the 5%. Everybody's situation different in what they're trying to go to, but I'm not going to sit down and say, okay, yeah, if you average five, I don't think that's five's a reasonable expectation. It doesn't mean we're giving up on making money. It's just if you're forward looking and saying, this is what I want to get, you might be disappointed when you get there. And people get focused on return too much is part of it. And you know what's the more important thing about wealth and accumulation? Savings. Savings. But what are people? They're chasing that one stock that makes them rich, having bought Apple. How many years does that take us back? Like 30 years ago? Yeah, it was back in the 80s. You could have got it for $2 a share, and it's now $200 a share. But it's like, oh, I got that, and you got rich. Yeah, everybody doesn't get to do that. People get lucky. But what's better is be more of the tortoise and accumulate money, get reasonable returns, kind of avoid losing it all when the market goes bad or that one stock goes kaput like GE, where you hung your hat on that dividend in them. What this is more about for most of us is working these assets forward overall. And yeah, some people get lucky. Some people start a bookstore in their garage and they're the richest person in the world. You know, so should you and I start a bookstore in our garage? How's that going to work